QuickBooks Pro Plus Desktop 2022 presentation. Credit memo, refund form, and bad debt expense. Get ready, because we bookkeeping pros are moving up the hilltop with QuickBooks Pro Desktop 2022. Here we are in our free sample file, sample rock castle construction, going through the setup process. We got the view drop down, the open windows list now open. We're going to open up then the home page, company file, home page. We're going to maximize the home page into the gray area. Then we'll go to the reports drop down. We'll go to the company and financial, go on down to that balance sheet standard report. There's our balance sheet standard report. Then go to the reports drop down one more time, company and financial, looking at the profit and loss, P&L, and or otherwise known as the income statement. We got our three items on the left in the open windows. Let's go back to the home page. In prior presentations, we've been looking at the customer section, the customer cycle, could be called the sales cycle, the revenue cycle, the accounts receivable cycle. Now focusing on this item down here, the refund and credits, or we could think about a credit memo. This can be a confusing concept because it will be dependent on the type of industry that we're taking a look at, and the actual journal entry related to it can be somewhat complex as well. So let's think about it first as a situation. If we have an invoice that was input, and then we're going to basically reverse the invoice before that invoice was paid, then you could go to the invoice, and this would be the way you want to think of a credit memo, thinking about the invoice first, what was recorded in the invoice, and then in essence reverse that, then making any tweaks you have to once reversed. It's unnatural for most people to think of a credit memo without first thinking of the invoice because the whole transaction is backwards. So what you want to do is think about invoice, maybe write it down, and then write down what's actually happening, increases and decreases or debits and credits, whatever you like, and then reverse it to analyze and think about what's happening with the credit memo. So if I go back to the invoice then, for example, then an invoice means accounts receivables going up. So if they haven't yet paid us and I need to reverse that, then the credit memo is going to have to take accounts receivable back down. The other side, driven by the sales item, if it were just a service thing that was done here, like work for bookkeeping or something, would be increasing revenue on the income statement side. And again, if there was no other inventory or sales tax or anything, and that was the simple transaction, then we could simply reverse the sales of it, having a negative sales if we were just to reverse it exactly. However, you might not want to reverse sales because oftentimes we only want sales to go up. We don't typically decrease sales. So you might want to tweak that second account instead of decreasing sales to rather put it in, say, bad debts or sales returns and allowances. So that's one kind of tweak or difference that you might have. Another thing you might have is if there is inventory, then you probably also have the sales tax, and you got to deal with reversing the sales tax properly, because if you paid the sales tax on a sale that you didn't actually make, then you're going to have overpaid the sales tax. So you want to adjust for the fact that the sale got reversed and then you don't owe the sales tax on it and so on. So you got to reverse that item. Also, if inventory is involved, then when we make the invoice, there's a decrease to inventory for an amount not even on the invoice but driven by the item, and the other side's going to cost of goods sold and expense. If they return the inventory to us, the question is, well, is that inventory still good? Can we keep it? Can we tweak it and sell it again or something, right? That means that we would have to put it back on the books as an asset, increasing the inventory, and the other side would be a reverse to cost of goods sold when we issue the credit memo. So those are all just with a normal invoice, kind of some deviations or variants. And then there's the question is, well, what if we invoiced them and they paid us back already? Or what if we issued like a sales receipt and basically they already paid us? When we then give them the credit memo, in essence, we are in essence either giving them a refund or giving some kind of credit to purchase something else because we had already gotten paid, and therefore we can't reduce accounts receivable, representing the fact that they hadn't yet paid us, but we would rather have to reduce the payment. So one way you can kind of analyze this in QuickBooks, and we will do this in OneNote and look at it from like an accounting journal entry standpoint. So you could look at that from just like an accounting standpoint. But if I go back to an invoice, note you got that nice form here in the reports area, which is the transaction journal. So this transaction journal, if this was the invoice you're looking at, you can look at the accounts that were impacted. these being fairly complex because we're looking at a job cost type of system, so there's multiple accounts here. But you can basically look at the account that's affected in terms of the journal entry, and then think about the credit memo and what's going to happen when you, in essence, reverse that. So I'm going to close this back out, and I'm going to close this back out. When you start like the credit memo process, you could then select this item directly here, and then you can choose basically the customer that you're going to be issuing the credit memo to. It'll give you some transaction history on the right, which could help you in that way. But I think it might be more natural first to find the actual invoice and then use that to link to the credit memo. So for example, if I close this back out and say, no, I'm not going to record it, you might then go to the customer dropdown, customer center, and then you might choose, say, a customer. Let's go to a customer side here and say, I have a credit memo. This person here wanted a credit memo or something. I'm going to choose that invoice. That's the one we need the credit memo for. And then use that in order to generate by going to the main tab and then say, I want to create a credit memo for that, which is in the main area on the ribbon, and refund and credit. And that will basically generate the credit memo. And then you can use those transaction reports to see what is happening with the credit memo. So if I was to create this credit memo, I'm going to close this out, and then you can kind of think of what happened on the invoice in order to apply the reverse that's going to happen. Credit memo, in this case, we're going to apply it then to the accounts receivable, reducing the accounts receivable, reducing the subledger for the accounts receivable, and so on. I think the easiest way to see this is actually to create a transaction and then reverse it. So what I'm going to do is I'm going to close this back out, and then I'm going to close this back out. I'm going to maximize this. Note that our date over here, they put everything in as of the 23rd. I'm going to put a transaction as of 2024, so it's like the only thing in our accounting system, so we can focus in on it. So I'm going to go to the Home tab first. Going to put another invoice in so that we can then put a credit memo related to it. I'm going to make a new customer. I know we haven't done this a lot yet, but this is going to be test customer. I'll put test customer, and that's all I'm going to put for this customer. And we're going to say OK. And then I'm not going to put any class. I'm going to put the date as of 01/15/24. So it's in the next year. So it should be basically the only thing there. And then I'm going to make a new item. This is going to be the item that we're selling. I'm going to try to make it an inventory item so that we have to deal with a more complex situation. As if we're selling inventory, we'll have a return on the inventory. We're going to say the inventory is going to be 10,000 sales price, and it's going to be then, that's going to be the sales price. Let's say 8,000 cost. That's going to the cost of goods sold account, and then the sales price we're going to say is 10,000, and then I'm going to say the vendor, the income account is going to be the income account. We'll just put construction income is going to be the income account. So that looks good. So I'm going to say OK. The item name cannot be blank. The item name needs to be test item. So we'll keep that. I'm going to say OK. And you haven't filled the successful quantity. That's OK. And I'm going to say there's the item. I'm just going to say one of these. And so there's going to be our invoice. It is taxable. So what is this going to do in terms of our financials? It's going to increase the accounts receivable by the full amount. The other side's going to then go to the sales account, but only for the 10,000. The difference, 775, going to then the payable account for sales tax payable. Then we'll have the inventory is going to decrease by the 8,000, not on the invoice. And the other side is going to go, but driven by that item we just put together. And then the other side is going to go to the cost of goods sold. So let's save it and close it and check that out. So then I'm going to go back to the profit and loss. I'm going to increase the date to the 24th, 01/01/24 to, I'm going to say 01/31/24, not 21/24. 01/01/24 to 01/31/24. So there we have it. So there's our transaction. There's the 10,000 increasing the income. There's our cost of goods sold. If I go to the balance sheet, and I'm going to make this as of 01/31/24, then we see that we have the accounts receivable should have gone up. Selecting the accounts receivable, and I'm going to change the date here from 01/01/24 to 01/31. There's the full amount, plus this, including the sales tax. And then the other side is going to the sales tax payable account. Sales tax payable account down here. There it is. Double clicking on it. Changing the beginning date from 01/01/24. There's the sales tax payable that needs to be collected. And then we have the inventory that's going to be impacted up top in the inventory item, which is here. Double clicking inventory and starting date at 01/01/24. So there's the inventory at the 8,000 that's going down by the 8,000. So now let's imagine that we're going to reverse this with basically a credit memo. They come in, they're going to give the thing back, and we're going to say, okay, I'm going to reverse it then. So we can then go to our credit memo, or we could find the invoice and make the credit memo from this. And I would think, let's go to the customer dropdown, customer center, and there's our new client we made. So we have the test customer. I want to sort the dates so I can see all transactions. And I had to go to the next fiscal year because I put it in the future. But we're going to say there's the invoice. Let's open up the invoice. And then I'm going to make the credit memo from that invoice. So I'm going to say let's create a credit memo, which is going to be the refund credit memo here. So we'll select that item. And then this will reverse it out. So it's going to reverse it out basically entirely, making the exact opposite transaction. Let's make it as of 12/20. Let's make it 12/24/24. And so this should basically, in essence, reverse it exactly. Now there's one little twist that will happen when we reverse it, and that is that it's going to basically reverse the sales item exactly driven by this item. And that might be something we want to change. So I'm going to say save and close. Let's see what it does. Now we also have these questions: return as an available credit. So we can apply a credit if we so choose for the return. Give a refund, which means it's going to lead us to basically a check form so that we could actually pay them, assuming they had paid us already. Or we're going to apply it to an invoice. That would be applicable if they had not yet paid us, which is the case here because we have the open receivable. If they had paid us, then we got to determine, are we going to give them a credit to buy something else or something like that? Or are we going to give them a refund, give them money at this point in time? I'm going to apply it to the invoice. So we're going to apply that out. It chooses the proper invoice. So I'm going to say that looks good. Done. And then let's look at the impact on the financials. Opening this back up. We're going to say the profit and loss. Then if I refresh this, let's go ahead and refresh this. Then I put it in there as a 12/24. So it's a long time. If you've had it for a long time, you're going to return it now. But then it's going to zero it out. So notice it reversed this. There's our sale item. And there is it reversing out. Now this is kind of the controversial component right here, in that it reversed it out to sales. And maybe I don't like sales going down, but I'd rather have it go into sales returns and allowances, or like a bad debt or something like that instead. Notice the cost of goods sold reversed out. The accounts receivable would then reverse out. The subsidiary ledger would reverse out. So we shouldn't have that open invoice, anymore. The invoice has been closed, even though we didn't get a payment, and so on. Now, so let's see if we can get that last little tweak though, and say I'd really like it to basically be going to like a sales returns and allowances or bad debt account instead of reversing the income. To do that, we could set up another inventory item. I know we haven't talked about items yet, but just let's do that. Let's check this out as we go. And you can always come back to this presentation after we get more familiar with the items. We can go to the credit memo here. And let's add another item as we go. It's like, I like that they reverse that, but I don't want them to reverse to the sales account. So how can I fix that? Let's make another item called bad debt. I'm going to create one, bad debt. There's one here. I'm going to call it bad debt 2. So I could basically make it as we go. I'm going to make another one. We're going to say yes. And I'm going to call this then, I'm going to make it an other charge. And then I'm going to put bad debt 2. And down here, I'm just going to make it go to the bad debt account. And so I'm going to say okay. And so this item is associated with an expense account. Do you want to continue? I'm going to say yes. So now we have that item there, and I'm going to say the bad debt. And now what I want to do is transfer the amount. So I'm going to put the amount down here to the 10,000 down here, and then the amount up top I'm going to keep at 0. I'm going to zero out the one up top. So because I made the bad debt taxable, we still have that tax impact down here, which is what we want. And then you might ask yourself, well, why do I still need the item if you're going to do it this way? That's because this item up top, although there's nothing in it, is still being driven by the inventory item. So if we got the inventory back, remember that's something that's not on the credit memo or the invoice, even though the item is doing it. So that's going to reverse that cost of goods sold and the inventory item, putting the inventory back on the books and doing the cost of goods sold. But it's not going to do then the sales side of things because we didn't put the amount here. But instead, it's going to be debiting what we assigned this item to do, the bad debt expense. So that's going to be the item that we could kind of tweak it around. Now, if we didn't get the inventory item back, then you could just simply reverse and just remove this first item altogether and reverse it to basically the bad debt if you so chose at that point. Okay, so let's save it and close it, see what happens. If I save it and close it with this tweak, I'm going to say, yeah, make the change. There it is, and I go back to my reports here. So I'm going to go back to the reports. Now the critical change is on the profit and loss. So now we've got the 10,000 up top for the construction amount, and then the bad debt is down here. So those two are reversing out. So now we didn't decrease the sales account, which oftentimes we don't like to do by using that little workaround with the added account, but instead have another account. We could have also made this other account go to, say, sales returns and allowances instead, to put it up in the sales returns allowances area. And then you also got to consider whether or not, there's going to be sales tax involved when you create that item. We'll talk more about sales tax and so on in the future presentations. But in essence, this one got reversed right here with the credit memo. The cost of goods sold still got reversed properly with the 8,000 because the item was still driving that 8,000 to be reversed, even though kind of we zeroed it out. And then if we go back to the balance sheet and I go to my balance sheet up top, it should have reversed out as of, let's make this 12/31/24 on the balance sheet in the accounts receivable. So the accounts receivable, I'm going to say 01/01/24 to 12/31. So there it is, reversing out on the accounts receivable. And it should reverse out in the inventory. So in the inventory, if I go 01/01/24 to 12/31, there it is, reversing out on the inventory. And then if you go to the payable for the sales tax payable, it should reverse out there as well, changing the start 01/01/24. So there it is, reversing it out on the sales tax. It would also reverse out on the sub-ledger reports, meaning if I go to the reports drop down, we go to the customers and receivables, and we take a look at the accounts receivable detail. Accounts receivable detail, let's go to the customer balance detail report and make this all transactions. Here's our test account. So it went up and then it goes back down for that particular customer. And then you'd also have the inventory report that would go up and down with regards to the inventory, tracking the inventory items. So note that the credit memo if you get that credit memo and you can understand how the invoice actually flows through to the balance sheet and then how the credit memo reverses it, that's a pretty complicated transaction. And then if you can understand how the items are set up in order to make the data input for that to work, then you're really getting a good grasp of what the accounting process is going. I highly recommend writing it down. We'll do this in the OneNote areas with basically journal entries as well, so you can see the accounts going up and down a little bit more transparent way.